Our next guest on TSB is a friend of the show. We welcome him back to the studio. He's an investment advisor, wealth manager, financial freedom advocate. He's a money manager working for the Continental Group International. Abhishek Datta, thank you very much for coming in once again.
Thank you for having me back.
It's great to have you in here. One of the things that we often talk about on our show is not just about money, but it's about how to invest and how to create wealth, how to build your wealth portfolio. When people are coming to you and you're meeting people for the first time, what are some of those misconceptions or those ideas that people have got wrong when they're first trying to build a diversified investment portfolio?
I think over the last few years, it's everyone thinks it's very easy to make money in the markets. That's the first thing that I tell them, that no, it's not easy. Mm-hmm. It might look easy. The news might make it seem like it's simple. But just because it's simple doesn't make it easy. Actually, building wealth over time is simple. You have to do the right things, have the right behaviors in place, and invest in the right assets. Don't over-concentrate your portfolio. These are some of the thumb rules that you use. But just because it's simple, again, people think, oh, it's simple, so that means I can do it on my own.
Right.
It's not. It's just because you can 3D print today a lot of stuff doesn't mean you're going to be good at it. I mean, you still live an architect, right?
I used to work for a company, and one of the fellows there was a financial advisor, and he'd say, I'm investing in this company, and he'd say the reasons why, and do your own research. So I'd follow his investment, but he wouldn't tell me when he was getting out.
Yeah. That's another thing. That's another thing. So most people are emotional, right?
Yeah.
And which is why most investors don't make money, including fund managers for that matter. Over the last 10 years, fund managers haven't made as much money as the indexes. And that's because we let our emotions rule our decisions. For example, most people chased this year or last year tech stocks because everyone thought technology is going to be the next big thing. But
it's FOMO, isn't it?
It is. It is. Part of it, it's the herd mentality, right?
Yeah.
Because your friends are talking about it, because that's what you're discussing at parties with with everyone, your colleagues. Someone's telling you they're making tons of money in Bitcoin. You think, oh, you're missing out, and then you follow the trend, and then you get caught at the wrong end because you invest when it's probably at its peak.
That is true.
And that's when everyone's talking about it usually.
No, which is so true. And what Kitch mentioned about a while back about exiting from a particular script. A friend of mine, and I know that person really, really well, invested in Bitcoins, when it was at 17,000.
Oh, we've all heard these stories, yeah.
Right? Reached 60,000 and in that vicinity. And every time, it was growing, he would always tell us, listen, you need to get in, and would with conviction say this.
Right.
There's another friend of ours, a common friend who is into portfolio management and all of that for HNIs. And he would always say, book your profits, book your profits, book your profits.
Absolutely.
Right? This guy never heard him. I would, whatever little profit I would make, I would take it out. And then when the crash happened, 64,000
right.
straight down to, 14,000.
14,000 odd, yeah.
Right? Everything that was parked there vanished.
Correct.
Everything.
And why is that? I mean, at the end of the day, why were you investing in Bitcoin in the first place?
See, I mean, the idea was, chalo, theek hai, while we are investing in everything else, this is also an instrument, maybe a little bit of, there is an uncertainty of sort, and probably that's where the risk factor comes in. But hey, life.
But what are you buying? At the end of the day, you're buying a piece of code.
Right.
And the only reason you were buying it because you thought someone else will pay you more money for it.
Which is true.
That's it. It doesn't have any value otherwise. There's no intrinsic value. There's no profits. There's no cash flows. Nothing. So what are you basing your investment decision on? So you were lucky, and your behavior was right when investing in a speculative asset. But most people don't have the right behavior, and that's where people like me come in to coach people.
That kind of behavior is true for non-speculative asset as well, right?
Of course.
Right.
Of course.
Be it funds, be it blue chip funds or whatever. People have this either emotional mindset that, listen, I have put in money, it will keep growing. It will keep growing.
No, it doesn't work like that. I mean, when I was growing up, everyone was talking about GE as a company, right? Jack Welch was a celebrity CEO. Yeah. But look at where GE is today. Nobody talks about it. It's not that company. So just because GE did well for 20 odd years doesn't mean it's going to do well for the next 20 years.
Which is true.
And that's how people invest. People look at past performance. People look at a company that they've known, that's familiar, and they think that's going to keep that's going to continue forever. It doesn't work like that, unfortunately.
I grew 4 or 5 years ago in Australia. I was there. There was a series of companies that absolutely boomed on the back of a rising Chinese appetite for Western foods,
right,
and vitamins, and companies just absolutely soared 200 and 300%. But government risk, at some point, China just changed their import tariffs and laws. Bang, gone.
Correct. So those are trends.
Yeah,
those trends don't last forever.
You can't pick them. Yeah, definitely. So when you're looking at that situation in terms of building that diversified investment portfolio, I'm fascinated by how much of this region's wealth sits in cash. In MENA, the research is about 73% of wealth is unmanaged. It's just cash in a bank account. Seems to be around about 50% in the United States. Now, that can be a good thing. It means, if there's a market downturn, you can invest, obviously, if you've got a lot of your wealth in cash. But why do you think it is so high in this region?
I think, firstly, it's lack of awareness. Money is a very, very touchy topic. It's very difficult for people to talk about money with people, and especially then seek professional advice, because unfortunately, the view is that only the rich people have access to financial advice, and that's not true.
Because the financial advisors I've spoken to have often said, it doesn't matter what you earn, come and speak to us. It's not just for rich people. It
is for everyone.
It is for everyone.
But then how do you break the barrier? Because, he's absolutely true. As I said, this friend of mine, he works for HNIs, and probably that's the impression that everyone carries, that the advisors are only advising the rich people because they have the money to give them for their advisory roles.
Correct. So like talk shows like these help, create awareness, because money. We all learn how to make money. We don't know how to manage it in the long run, and that's a problem. You don't want to be at 65 years old and still trying to make money and saving up.
You suddenly got to find and try. You had a great career, but at 65 you've got to find a job at Spinneys.
Exactly.
We hear those stories.
There are those stories. Yeah.
Look, I used to find a lot of great radio announcers that had never done that. That's why I went off when I was about 29 and did a master's. And there's 30 grand I'm in debt for.
yeah, absolutely. So a lot of these things, for example, debt is not a bad thing.
Yeah, we've got to get away from that idea that debt's a bad thing.
Debt's not a bad thing. Look at companies like Apple. Apple raises money by issuing bonds at very low percentages, but even it doesn't mean they don't have cash.
Okay, so that is the point. So you've got Apple. I think they were at some stage the first $1 trillion company.
Right.
They've got reserves of cash that are greater than a lot of countries.
Okay.
Then I know the answer to it, but please inform us again. Then why do they still seek to borrow money when they're looking to invest?
It's very simple. Let's say I can borrow money at 3%, which let's say Apple does. But if he can make 6% on that cash, that's 3% arbitrage. That's 3% returns on billions of dollars for free. Because you're only paying 3%. If you find that opportunity...
But is it not also in some countries that 3% may also be tax deductible?
Even if it is, let's say you pay 30% on that, still making 2.1% free.
Yeah.
So, if you have the right avenues to invest, and if you borrow, and you manage that borrowing carefully, then you're fine. If you manage your cash flows and you're borrowing carefully, you're doing a good job. There's nothing wrong with... Everyone does that. Elon Musk borrows money, right? He borrowed money pledging his Tesla shares to buy Twitter.
Yeah.
He could have easily sold those shares, but why? Why would you sell an asset that is growing?
Makes sense.
And if you pay a fixed interest on those assets, it's a no-brainer to me. But again, it's financial education that needs to be more and more, propagated by people like you. It's very important.
We keep talking about it, that, whatever we studied in school, at university, none of these subjects that we studied in either of the streams ever told us or taught us about financial education, right? All our jobs, whatever they are, from our education, if they have stemmed, they've taught us to make money.
Absolutely.
Right?
Absolutely.
Because once you have a degree, once you have a master's or whatever, that you'll get into a junior managerial position and then a managerial position. You'll make money.
And then in India, you'll find a good wife as well.
Oh, yeah, absolutely.
And then you'll lose all your money.
I didn't say that, you did.
No, but it's true. I think that is why some people, they go through school, they go for university, but they finally learn how to manage their money by reading Rich Dad, Poor Dad, or reading...
Or by losing money.
Yeah, or by losing money.
No, or they borrow too much to go to school. For example, in the US, I know the student debt is a massive problem, right?
Yeah, look, I looked to study in the US, but I looked at, it was 200,000 US.
Absolutely, yeah.
I did 3 courses. No, but you looked and you were like, how talk about a divide between rich and poor.
No,
it's extraordinary.
That's when, so education also needs there needs to be a democratization of education, because access to education should not be because of how much money you have.
True.
Every government in the world needs to take care of that. And if that is done, automatically people will be better prepared in life. And then, they will also then they'll have more access to, financial advice, because
Abhishek, we do have a message that's come through on 0586861003. We'll see if you can answer this one. Good evening. I'm enjoying the show, guys. I have a question for Abhishek. I'm 53 years old.
Mm-hmm.
I want to park my retirement corpus in India where it will grow reasonably. Where should I park my money?
Oh, wow. That's specific. Now, reasonable returns is different for everyone. As a 53-year-old, it's important to know, when is he planning to retire? Is it at 55? Is it at 60? Is it at 65? I don't know what he does. I don't know how much he makes. I don't know what his expenses are. Like I said, it's simple, but it's not. It doesn't mean it's easy. I need more information. I mean, I can give that advice, but I need more information to give out. There's a lot of instruments where, the basic rule is what I call a thumb rule, is the 4% rule.
Okay.
So if you need $100,000 to survive, you should have 25 times of that in the bank when you retire.
Okay.
So that's basically, if you have $2.5 million, you invested at 4%, which is very low risk, you will have enough income to survive.
Okay.
It's as simple as that. So it's a thumb rule. It's not a very scientific rule, but it's a very simple, easy way to give yourself a target of how much money you need to save up.
When it comes to working with people, so they're in those situations, they may have a windfall of some money or they've got some savings. How much does their personality dictate how their money should be invested?
That's a very interesting question. So, anyone... I met a client once and he said, I'm a very conservative investor. I was like, so what kind of returns are you looking for? He's like 15 to 20%.
So, that's conservative.
Exactly. So, people, there's one thing about understanding risk, and then you have your own risk tolerance. So you might say, I want 20% returns. But for 20% returns, you should be able to, you should have the appetite to survive a 40% reduction in the portfolio.
Yeah.
Because that's what it's going to take for you to get to that 20% returns. So a well-diversified portfolio will in the long run make sure that you get those returns. But in between, the volatility is going to play with your emotions. And when people get emotional, they see their portfolios are on 40-50%. They tend to sell.
Yeah.
Right.
They panic and they sell. And that's where a financial advisor and a well-diversified portfolio comes in.
Now you can say, that one was down, but these 5 or 6 are up. And
Correct.
Yeah.
The biggest
you only lose if you
investors,
sell.
the biggest investors in the world, by the way, don't make money on all the stocks they invest. Some of the oldest portfolios in the world probably had 2 companies that did well out of 20. But those 2 companies grew at such exponential rates that those other 18, some of those companies don't even exist today.
Right.
But, those two stocks did so well for them that it doesn't matter what the other 18 did.
So when you say diversification of, investments, how does one plan or understand what is right and how much of diversification in what all, jurisdictions does one go? Is it dependent on risk factor A? Is it dependent on how much money they have? Or is it that just diversify?
No, so it's all of those factors that you brought in. Everything counts. So how much money you make, how much do you spend? Are you overspending? Can you control that? Can you reduce some of your expenses? Where do you plan to retire, for example? Now, if you plan to retire in Dubai, you need a lot more money. If you plan to retire in India, you'll probably need a lot less money.
Right.
So all of these factors come in. How many kids do you have? Do you plan to pay for their education? If you do, well, what do they want to study? It's a very diverse topic. So it's not one size fits all. I mean, it's like I said, the internet and everything makes it seem like, you buy these stocks and you'll be rich.
Or some of those apps.
All these get rich quick schemes. Right. It doesn't work.
How about those apps which have AI models backing them, where you put in money and then that money is then taken care by them, and investments and all are taken care by them?
I think there's a place for that in your portfolio as well. But again, we talk about behavior. And AI can also lose money. I have seen AI funds that have gone down during the 2020 crash.
Wow.
So what happens then? Who is going to tell you what to do with it?
So humans more intelligent than AI?
No.
For the market?
See, AI has IQ, humans have EQ. There's a difference, right? We can perceive things, we can see a product, we can touch and feel it and see if the company that is selling that product or making that product will do well. And AI can see numbers on a balance sheet and say whether the company is good or bad, the cash flows, etc. So yes, valuation-wise, an AI can pick it, but an AI will not be able to tell the product that company makes whether it will grow for the next 20 years.
Right.
So there's a place for everything in your portfolio, but you have to have the right allocation based on your risk profile. Otherwise, you'll always end up losing money.
Abhishek, we're also out of time, almost out of time. We'll go through some of those three key points. So when it comes to those techniques to avoid market volatility, diversify, balance portfolios with protective asset classes, and invest consistently. Consistency is key.
Absolutely. I mean, anything in life, right? If you go to the gym once a week or if you go 5 times a week, there's a difference, right? So, I mean...
is there?
Well, I hope so. I mean, that's what I've been told.
Abhishek Datta, the investment advisor, wealth manager. If people do want to get in contact with you, they can get in touch with the Continental Group International?
Absolutely. Or you can reach out to me on LinkedIn, or you can, call me. My number's on LinkedIn. If you want me to give it out, I can give it out right now.
Yeah, please, go for
it.
It's
055-3539-327. I'm available on WhatsApp anytime, so please reach out.
Continental Group International, that's where you can go and Google. We could speak to you for hours. Thank you for sharing your knowledge, Abhishek.
Thank you.
Abhishek Datta here on